Today I want to talk to you about the various order types that there are for trading. You've got so many order types. There's market orders, limit orders, short orders, fill or kill, immediate or cancel, pre-market, post-market. Let's first of all start off with one of the most basic order types, the market order.
Your entire strategy is based on what you option. I'm going to give you your entire strategy based on what you. I'm going to give you the
Market order is very simple. You're placing an order and you're expecting to get executed at whatever the current market price is. You're not setting any kind of price constraints. A lot of times traders will use market orders when they need immediate executions. So, I need to buy 2,000 shares of IBM right now. I don't have time to waste. I need to get the fastest possible execution. And the way to do that is with a market order because you're setting no constraints at all. The next order type is limit. So now you're saying, I want this order to be executed at this price or better. The next order type is short. With a short order, basically, you're selling shares of a stock you don't own. You basically have a margin account which allows you to borrow shares of stock that you don't own. So you borrow the shares, you sell them at the current market price, let's say $20 per share. You put $20 per share in your bank, you wait for the price of the stock to go down, let's say it goes down to $10. Now you can take half of that money that you have in the bank and use that to buy back the shares that you borrowed, give them back to the person that loaned you those shares, and you profit from the difference. Basically, whatever the difference is, that money that you saved by the stock price getting cheaper, that's your profit. And that's a short order. Also, keep in mind, this is a short-term investment strategy. You're paying interest on the loan. Any dividends on the stock goes to the owner of the stock. Another order type is stop. You have stop orders. Stop orders kind of give you like a safety net. So essentially, you can actually limit your losses. You can set a trigger for the order. You put the order in with a stop price. Once the price of the stock reaches or hits that stop price that you put in, then it becomes a market order and it will execute. This is something that a lot of momentum traders will use. So let's say I'm sitting there and I'm thinking IBM's about to go up. Its average has been around $10, $10.50. I think it's going to break to $11, $11.50. Right? So I think it's going to do that. But it's hovering around $10, $10.50, $10, $10.50. I want to jump in when it starts breaking that barrier and going up higher. That's why I want to jump in. Right? I don't want to sit there with the stock, just hovering around. So what I can do is I can put a stop price slightly above the range that it's trading in. So the order can go live once the price barrier has been broken. So I want to jump in when it exceeds that price by a certain amount because that's an indicator to me that the price is about to go up. There's another advanced type of stop order called the stop limit. Now you can also put a limit on the order. So not only is the order triggered once you breach a stop price, but there's also a limit on the order so that you're protecting your losses. You've got to execute me at this price or better. If the stock jumps too quickly, then I may never get executed. But I definitely won't get a bad price because I'm putting a limit on there. There's something called time in force, which is something you can apply to an order. So you can have something like fill or kill. You've got to fill this order or kill it. Or there's also something called an IOC. An IOC order is basically immediate or cancel. I want you to execute this order immediately or cancel it. If you can't execute right away, just cancel my order. Then there's a very dangerous time in force called good till cancel. And it's dangerous because you're saying this order should be good until I cancel it. So that order can sit there on the book for ages, just sitting there. And who knows where the stock market will go. So imagine you've got an order sitting on the books for 2 weeks, a month, a few months, and who knows where the stock market is going to go in that time. And you don't even remember about this order because you put this order in a long time ago. So you can see the potential to forget the order and then you get executed, when you don't want the order to be executed anymore. And those were some of the most basic order types that you should know about.